Welcome back to the second episode of learning, and today we are going to look on candlestick anatomy. So in our first lesson, we learned about introduction to forex trading. So basically what we did is that I introduced you to what is forex and how it's done, who are the market participants, and at what time is it trended, and what is being trended there in the forex market, and the type of traders that we have. And now today we are going to have a lesson of a maximum of 15 minutes, and we are going to cover on candlestick anatomy. Now basically, a candlestick is a visual representation of price movement during a certain period of time. So forex trending is basically analyzed using candlesticks. So candlesticks are the ones that you are seeing on this screen, the ones with a green and red color. Those are the candlesticks. So we are going to know how to interpret them and how to understand them, because in the forex market, the market communicates using a lingo of candlesticks or candlestick language. So we are just going to do an anatomy. Anatomy is like when you are standing a human body. Now we are standing a candlestick. Yeah, we are going to see how it interpreted, how it is formed, and what it means when a particular type of candlestick is formed. Now, the first thing that you're supposed to understand is that a candlestick is formed during a certain period of time. For example, we have candlesticks that are formed every 1 minute. Then we have candlesticks that are formed every 5 minutes, 3 minutes, 2 minutes, 10 minutes, 15 minutes, 20 minutes, 30 minutes, 1 hour, 2 hours, 3 hours, 4 hours, 8 hours, 1 day, 1 week, 1 month. Yeah. So we look at the time frame when our candlestick is formed. And the best way to analyze the market is that you do something we call top-down analysis. You go from higher time frame, like for example from daily candlestick. That means one candlestick is formed after 1 day. You analyze from daily candlestick, then you move to 4 hours. For example, 4 hours means that one candlestick is formed after every 4 hours. Then you move to a lower time frame like 1 hour. That means that one candlestick like this one is formed after every 1 hour. Then you can go to 30 minutes. Yeah, like this one. These candlesticks are formed after every 30 minutes. Then you can move to 15 minutes like this one. They are formed after every 15 minutes. So the higher the time frame, the more the accurate the analysis will be. So that's why we use the top down approach while analyzing the market. So let's start by understanding how a candlestick is formed. So a candlestick has two parts. It has the body and it has the wick. So I will illustrate with this candlestick here. Yeah, this green candlestick here. So you can see that the body. The body is the distance between, the body is the distance between this place and yeah, where we have that line. So that is the body. Let me name it for you. Body. Then we have the wick. The wick is this one. Wick or the shadow. So when a candlestick, we have two types of candlesticks. We have bullish and bearish candlestick. Now a bullish candlestick is the one that is formed when price closes higher than the opening point, or when the price opens and closes above the opening price. For example, the price opened here in this candlestick. This is in gold. The price opened at 24.63 and closed at 24.95.45. So that is a bullish candlestick. The opening price is lower than the closing price. Yeah, or the closing price is higher than the opening price. That is when a bullish candlestick is formed. Bullish candlestick. Is a bullish candle here. And then the second type of candlestick is bearish candlestick. A bearish candlestick is formed when the price closes lower than the opening point. For example, in this scenario, we have our opening price here and the closing price is here. So that is 25.30. That was the opening and the closing was 25.10. So you see it's lower. Now that is a bearish candle. Yeah, this is a bearish candle. As usual, this is the wick. The wick can be on both sides of the candle and at times can be on one side. So for this case, we have the wick on the lower side. This is where we have the wick or shadow. And the bond is this red part. So basically, bullish candles are represented by color green and white. On the other hand, bearish candlesticks are represented by color red and black. Those are bearish. Bearish is red and black, while bullish is green and white in most cases. You can use any color as long as you know that bullish candle is formed when the price closes higher than the opening point, and a bearish candlestick is formed when the price closes lower than the opening point. That is the key thing that you need to understand when determining the type of candlestick that has been formed. So for our case, we have already identified a bullish candlestick and bearish candlestick or bearish candle. So that's basically the component of a candlestick, the body and the wicks. Now, let me talk something on the wicks. Now, wicks are the extension of the price above or below the body of a candlestick, and they represent the maximum and the highest and the lowest point where the price reached during that particular time when that candlestick was being formed. For example, in this case, the price came all the way from 24.63 and reached 24.99, but then went lower to close as 24.95. So the difference between 24.95 and 24.99, that is the wick. That is the shadow or the wick. Now it represents the highest price point that price reached during that time, during that 1 hour time when that candlestick was being formed. And wicks inform you the the volatility of the market during that particular time, the movement, the price movement. It moved higher and then came back lower, but the price managed to close above the opening point, meaning that buyers are control in the market. So that is the interpretation of a bullish candlestick. It means that buyers are in control in the market, and the bearish candlestick is a vice versa of the bullish candlestick. So it means the buyers or sellers are in control of the market, and that is when the price closes lower than the opening point. Now, a wick can also be formed on either lower or upper side. For example, now we have this bearish candle here, this one. We have this bearish candle here. So as you can see, this is the body. Let me show you the body. So the body is here. Yeah, here. And now we have the wicks. That is the wick, and this is the wick. So we have the body. We have the wicks on both sides. That is wick. Also we have another wick on the lower side. What does it mean in this case? You can see what happened there. The price opened at 24.7 and closes 24.44. So that means it is a bearish candlestick, but then it has wicks on both sides, on the upper and the lower side. The wick on the upper side represent the maximum, the highest point reached by the price during that particular time. So this was the highest point, 24.69, and the lowest point was 24.31. So what does that mean? That means that despite the fact that price opened at 24.57 and closed at 24.44, it went both on the upper side higher and the lower side. However, it didn't close at the highest point and at the lowest point. That's why it left the wicks on both sides. So basically that is the interpretation of a wick. So inakuonyesha tu mahali price ili reach on the higher side and on the lower side. So inaonyesha the trending activity that was happening at that time. It shows that there was a lot of struggle between buyers and sellers. They were all selling and buying. There was that pull and push in the market. But at the end of the day, the sellers won, and that's why price closed lower than the opening point. So with that knowledge of interpreting when a candle has been formed, then you can be able to tell where the market is going. If the candlestick is bearish, it means that sellers are in control. On the other side, on the other hand, if the candlestick is bullish, it means that the buyers are in control. So that's how you interpret a candlestick in the market, and that's how you are able to predict the price movement. So if the price is continually printing bullish candles, then it is a bull market, and you are supposed to look for buying opportunities. On the other hand, if the price is continually printing bearish candles, then it means that sellers are in control and you are supposed to look for selling opportunities. You are supposed to look for sales. Yeah, that's basically what you do through interpretation of a candlestick. Now, the next thing that I will come to talk about is different types of candlesticks. But before we go to that, in our next lesson, we will have to cover different types of market and also different times to trade in forex market. So we'll look at different types of the market and also determine the different moves that we have in the market. And from now then, we'll come to look at different types of candlestick and candlestick patterns that will help you to be able to accurately predict the direction of the price in the market for you to buy. So the chart that we have used today for our analysis is a gold chart, and is at now then gold is very bullish. It is printing bullish candles. As you can see on 4 hour, we have 1, 2, 3 candles which are very bullish. If you drop on 1 hour, you realize there are several bullish candles, 1, 2, 3. So that market is bullish. You just need to look for buying opportunities and make money. However, at this point, we are close to a resistance level, so you can't buy at that point. You have to wait. So guys, thank you for watching this video. I hope you learned something on candlestick anatomy. If there is something that you haven't understood, kindly feel free to ask in the comment section and I will cover it in the next video. And if you haven't subscribed to my YouTube channel, kindly consider doing so that you get update whenever we update our videos. Remember, our videos will be coming to you every Monday, every Wednesday, and every Friday. Thank you for your time.